Good afternoon. Welcome everybody to another edition of Market Matters. We do apologize for the technical difficulties that we're experiencing as it related to the outage with Amazon Web Services. It does appear our web hosted environment is supported by web services, and that's providing a little bit of an issue for us. But because we think this information is timely and we wanted to make sure we deliver on our commitment to you to bring you this monthly webcast series, we thought we'd record it. Send it out today, and then resume our normal live webcast series starting in January. So with that, let's get started. Turning to the agenda, we've got more of a traditional agenda now where we'll look at a quick economic update, moving to the investment outlook, and then finally touch on the special topic this time, which is the digital assets opportunities that we see in 2022 and beyond. This has been a hot topic for a lot of clients. So we thought we'd address it here again in maybe a different way and just give maybe an overview of the landscape for those that would like to learn more about this. So let's get started. Turning to the economic update, one thing that I wanted to just point out with this chart is that inflation is turning from not just a social issue, which we all are experiencing, increases in prices for a variety of goods and services that we consume. But as the chart suggests, it's also turned into a very problematic political issue, particularly for the Democrats and President Biden, which you can see as CPI, and this is the light blue line, the Consumer Price Index has risen over the course of 2021. President Biden's approval rating has fallen commensurately as CPI rises. We'll see what kind of correlation this exists here, but I think it's just emblematic of the fact that this dynamic is going to force the hand of policymakers to don't just sit there and do something. So what are they going to do? Well, they've already tried to mess or tinker with the energy markets by releasing the Strategic Petroleum Reserve to a level that's now dangerously low, in my opinion, really to no effect on the crude markets. So they've released two batches of oil into the open market from the Strategic Petroleum Reserve, and it's had relatively little impact as Brent crude is now, or WTI crude is now right back where it was almost exactly before those releases occurred. But I think as a helpful reminder that people or policymakers, particularly even maybe the Fed, will try to do something to try to attack this problematic issue of inflation, which we think will likely resolve itself one way or the other in the next 6 to 12 months. Not to say that we're going to go back to this 1.4 level in inflation, but probably sustaining at a higher level, somewhere between 2.5% and 3%, but definitely not in this 6% range. So we'll have to wait and see what other policy responses come out of Washington, but you better be sure they are close at hand. Turning to the U.S. consumer, because that consumer consumption powers roughly 75% or so of the U.S. economy. And as the consumer goes, so goes the economy, is the old saying. And what you can see here, just one indicator of the health of the U.S. consumer is retail sales. And what you can see here is in the blue line is retail sales, including food and gasoline. And the red line is retail sales excluding gasoline sales. And what you can see here is that after the COVID recession that occurred here back in 2020, retail sales have ratcheted back up into a new higher level. And that's obviously a combination of a number of different things, but it's government transfers have provided a lot of cash to consumers by way of just direct payments. Higher savings rates have occurred too because of people getting scared of that they're not going to find work or have a more difficult time finding a job. And then also, I think job flexibility is contributing to a lot of this because, if people are paying potentially less for a home in a cheaper market than, let's say, San Francisco, New York, or New Jersey, for that matter, they are going to be using that money to buy things. And I think that's just what comes along with the territory. But I think this chart just suggests that the U.S. consumer is doing quite fine. And until we see any wobbles in this and a few other indicators that we follow pretty closely, that we're not necessarily going to change our opinion on the outlook for the U.S. economy. So it looks, all in all, looks pretty healthy, but we do have an inflation problem that needs to be addressed. And we think sometime in early 2022, that will likely occur. Let's turn to the investment outlook. Briefly, not a whole lot has really changed since our last Market Matters from back in November. You can see we still have an underweight, reflecting that emerging market downgrade that we pushed through the investment committee at the end of Q3. And I think this was probably a well-timed downgrade, because the situation with Chinese stocks has not gotten any better. In fact, it's gotten worse since this downgrade. As you all may be aware as well, we have very little, if at all, in some accounts, exposure to emerging markets, and that's certainly served us well, as most of our exposure in accounts continues to remain in the large cap, US large cap space, which has dominated performance of global equity markets this year. We still have a preference, as you'll see on the next page, for alternative assets, whether it be liquid or less liquid. And let's go into that, some of those insights here, or portfolio notes. One is, again, respecting what the volatility markets are telling us. And this is actually volatility coming through both in the stock market and now the bond market. Volatility really just is a reflection of the fact that uncertainty is increasing across a number of different categories. And this is something that we are looking to try to take advantage of. And there's a number of different ways to do that. We are also looking at tax loss opportunities across all of our accounts. So whether it's in our single stock strategy or in our ETF mutual fund strategies, we're being very aware of capital gains and capital gain distributions coming later this month. So we will be positioning ahead of some of those items that we know are coming. On the equity side, we still have a preference for US large cap. This has not changed for quite some time. And we have to have, I think at this point in the cycle, really good reasons to shift off of our large cap exposure, because the small cap market, I think, is showing us, as I mentioned in this week's 2 Minutes with Todd slide deck, it's telling us that something is not all that right within the small cap space or with small companies. And with that being the case, we are just going to have our preferred allocations remain within US large cap. Fixed income wise, this has been a challenging year for fixed income. There's no question about it. On the plus side of that, even though the indexes are mostly negative for fixed income, our strategies, because they're a little bit shorter duration, potentially a little bit higher quality, but have some positions that can add alpha, are broadly positive right now in 2021. So that's a positive mark. Even though it's not a lot of return in fixed income, it's still serving that purpose of capital preservation. And that's despite the fact that the fixed income markets are actually negative. So we're pretty happy with that outcome so far. But inflation definitely is a question mark, and we see it migrating down towards a higher trend rate over the intermediate term. So we'll have to be mindful of when those transitions occur, because there's always volatility in transitions, but we'll be keeping an eye out for what might create some air pockets. And then, of course, on the alternative side, we are continuing to shift capital away from traditional fixed income and some strategies towards strategies that will benefit from higher volatility levels or differences in pricing. And we also, just as a portfolio note, have just recently launched a growth vehicle called Trailhead Growth. It's for qualified purchasers. And this is a private strategy that's meant to capture opportunities in a couple of different areas we find really attractive right now: digital assets, venture capital, and then what I'm calling non-correlated growth strategies. And that can be anything from long and short equity funds to development real estate to litigation finance, so on and so forth. So we're pretty excited about that. Moving to global stocks, it is definitely a disparate picture this year, whereas in prior periods coming in 19 and 18, everything was pretty similar in return profile, whereas this year we're seeing quite a bit of divergence, and that divergence started to occur middle of this year, whereas you can see most things were trading around a certain range of, that was pretty well defined. As we move further into the year, you can see there have been some pretty big divergences that have emerged. And again, most of our exposure on the equity side, roughly 70 to 75% of our equity exposure is in this black line, the S&P oriented positions. The blue line here is small cap index. This used to be leading the way higher, but it's not any longer. We have no exposure here, but quite a big difference has opened up between large cap companies and small cap. We do have about between a 20 to 30% allocation to international large cap companies. This is Europe, Japan, and other developed markets internationally. Again, a lot of the reason for, now there are high quality companies in international markets, but the US dollar this year has been very strong. And so therefore that's pushed or kept the lid on performance for international markets. Then of course, emerging markets down for the year, down almost 5% as of December 3rd, when I put this together, is a big difference between the plus 22 that the S&P has experienced so far this year. Again, almost no exposure here. And I think that's just part of our risk management process that's allowed us to not have a very large weighting here. Moving in, this is another way to look at returns. I just showed you the line return, but here, this is a way to look at returns based on the composition of where those actually came from. So the blue line, the blue bars are earnings growth that's occurred within each of these regions. And this is by US, Europe, the United Kingdom, Japan, so on and so forth, as of December 3rd. So we have earnings growth combined with dividend yield. When then you add in currency return, which can be plus or minus for international stocks, and then PE multiple expansion or contraction. What drives this up or down is a variety of different factors. It can be momentum, it can be inflation expectations. But I think one thing that I'd take away from this chart, which I think is good to see, is that the PE multiple has contracted across all of the regions of the globe. And that's, I think, because bonds have been competing or inflation, I'm sorry, has been much more of an issue, and stocks do not like inflation by any means. So this is actually a welcome dynamic, because if we had a lot of multiple expansion last year, and I think most would agree in investment circles that the P multiple was too high, and the way you grow out of where you get out of a high P multiple is to see that contract a little bit, but also have earnings growth offsetting that PE contraction. So you can see that that's occurred pretty nicely across all regions, which is very good to see. Looking at currency is actually impacted. This is what I was saying earlier, every region except for China, because China still has a quasi peg of their currency to the US dollar. But you can see all other areas internationally have been impacted by a strong US dollar. And this is just part of our thesis that, international stocks can be very tricky to try to figure out sometimes. And part of the big reason of that is because of this currency and what that's going to do. So we've taken a very cautious approach there. We do need to be mindful, however, and I do see people making some correlations between now and the tech bubble with technology stocks in particular. And you can stretch it even back to the era of the Nifty 50. And what this chart right here shows, going back all the way to the 1920s, is the technology sector divided by the S&P 500. If the number is above 1, that means that the technology sector is outperforming the S&P. If the line is below 1 on this chart, it means that the S&P is outperforming the tech sector. And so you can see big periods back in the Nifty 50 era, mid 60s to the early 70s, the tech bubble, the 2000s, and now here we are back to a pretty elevated level in the early 2020s. So we do need to be mindful of the price we're paying for stock and stock selection or individual stocks. But I think this is where an active approach will be really instrumental in maintaining and earning a return that's adequate and positive into the future, because there are pockets of overvaluation, SPAC market being one of them, which we'll touch on in just a minute, that we need to be aware of. But all in all, I don't see as big of a risk now than what we had in March of 2000, because again, one of the big reasons I'm not as fearful is because technology companies now are actually by and large profitable versus back in March of 2000, the largest companies in the S&P were unprofitable. So something to just consider on that front. Another chart to keep in mind is that we do have an era of what are referred to as negative real interest rates, which means that if the level of the 10-year bond is not higher than the inflation index, then you have a negative real return, or so-called negative real return. And so in prior periods when you've seen this, it actually means that there could be potentially some future gains on the horizon, because you can see where we are right now, negative real return of roughly negative 3.9. And in other periods, we've gotten down to these levels in the late 70s and early 80s. What's been the experience in the stock market and the bond market? Well, the stock market does appear to be fairly positive when you're in a negative real rates scenario. But the bond market is much more of a question mark. And I think that's also our contention here as well, too. And that is, we're much more suspect of bonds being able to eke out a positive return of any sort. Whereas on the equity side, it does appear that this would be where a fairly positive dynamic if we stay into this real region, negative real rates region, and move gradually higher from there. And just a word about SPACs. I mentioned them earlier. SPACs are otherwise known as special purpose acquisition corporations. And in our opinion, for any client that's ever asked us about these, we've always thought, well, there may be some diamonds in the rough, but by and large, SPACs are not a great investment vehicle to be considering, because the terms are just really onerous for investors. I mean, they're billed as this way to give the public exposure to what would be otherwise venture capital like opportunities that are very early stage. But I think what this chart suggests here is that not a lot of people are making returns, especially as it compares to the Russell 2000 Growth Index, which is maybe another benchmark to use for small cap or smaller growth-oriented opportunities. And you can see here, someone that's just a buy and hold investor in the SPAC market has done +4 in aggregate since 2019, which is when SPACs really became popular. But versus the Russell 2000 Growth Index, it's actually, you've lost out some opportunity costs to the tune of about 50%, meaning that the Russell 2000 Growth Index outperformed by about 48 percentage points versus this 4%. PIPE investors, these are other participants in this market, and they've not fared very well either. But the people that have benefited, let's just move our eyes down to this bottom line here. The people that have benefited pretty mightily are the people that have put these SPACs together. So those are otherwise known as sponsors. And the sponsors, you can see their return here over this time frame has been pretty gargantuan, because the terms, like I said, going back to the SPAC terms, are just so preferential to the sponsor that we've always found it very difficult to find anything worth investing in. So I guess buyer beware is maybe our point here. International stocks, moving to them, it's been like I mentioned on the outset, it's been a very disparate year. But with valuations or performance differentials what they were, is it time to adjust our track? And we're always asking ourselves these questions. And I think it's helpful to continue to ask your questions, because you continue to reevaluate your thesis on these areas. And I think one of the key features that is emerging from our discussions that we're having on the investment team is that international markets are really difficult to forecast, particularly in emerging markets or tertiary markets, because of the currency component. The currency component is a major driver of returns, and it's something we need to have a better handle on in many cases before we can get too interested. And this is, I think, the Turkish market, what you see here, really exemplifies why this is so difficult. So what you're seeing on the screen is just 2021, so starting in January. The black line is what they call the Turkey Titans 20 Index. It's basically the Dow 30 of Turkey. And in the local market, Turkish lira, local markets, it's up 27%, which seems pretty good. But then you have to factor in that if you're a US based investor, you're investing in US dollars. What have those Turkish lira denominated investments done in dollar terms? And it's actually the exact inverse, which is really sometimes difficult to wrap your head around, which basically means that the Turkish currency has actually lost roughly 50% in value versus the US dollar. And that's what this is showing here, that even though you got a plus 27 on your stocks, the currency wiped out, took you down, -50. which netted you at a negative 27 when all is said and done. So this is why it's just exceptionally challenging to want to look at international markets, in particular tertiary or emerging markets, because the currencies can be so volatile and so meaningful to returns over the long term. So we're still very cautious, I guess is my point. And then finally, fixed income. This has been kind of a ho-hum or disappointing year for fixed income. And I still think we're looking for a catalyst. The fact that we can't get higher bond yields, even despite the fact that we have a 6.2%, maybe going closer to 7 inflation reading, just tells me that there either is quite a bit of concern of an economic slowdown on the horizon relating to maybe Omicron or other logistical issues, or that there's other factors involved that, like central bank involvement, that might be keeping a lid on yields. But despite that, if you're looking at high quality indexes, aggregate bond index or the investment grade bond index, they're still negative for the year. And this is, of course, including the coupon that you've received so far this year. So we are continuing to be pretty cautious with this allocation for our clients. Again, still very happy that we were able to achieve positive performance, even though we've had a negative return, and we will look for ways to do that going forward. One thing I did want to mention, and it's actually manifesting itself here over the last day, 2 days actually, but when I put this together on Sunday night, all of the sentiment indicators actually were looking pretty negative after the big sell-off that happened last Friday. A number of different indexes were actually down somewhere between 5 and 7% for very speculative indexes. And that was, to me, indicated, we might have had a bit of a washout in a lot of different areas. And subsequently, a lot of investor measures or individual sentiment measures have all turned very fearful, which is a contrarian sign that it might be okay to dip your toe back in the water in certain areas. You can see that everything from the CNN's Fear Greed Index was registering extreme fear. The AII bullish sentiment indicator, which only showed 26% of people bullish as of last Friday. The volatility index, the VIX index, which measures or registers the amount of put buying that occurs with S&P 500 put options, was at a very elevated level of about 29. You can see the average is between 13 and 19. So that's definitely positive. And then the put call ratio, meaning that how many puts, which are protective, versus calls, which are speculative to the upside, were being purchased, was now in favor of puts, which means that people were more fearful and seeking protection. And so all of these things together just told us that this week would likely line up for a pretty positive week and potentially into the end of the year from here. So we think maybe that was one of the bigger sell-offs that we were looking for in December, so that would pave the way for maybe a little bit higher returns in December from here. So just some key takeaways. We still continue to favor stocks over bonds, even though bonds have low forward-looking returns. That means that we have looked at slightly higher allocations for stocks, but also looking for other ways to generate return with that bond portfolio or that bond portion. We continue to favor U.S. companies over international, for the reasons I suggested around the complexities with the U.S. dollar and the currency issues. Alternative strategies, we still have a favor over bonds, because there are ways to generate income that don't necessarily correlate or correspond with high quality bonds right now, which clearly is where the Fed is trying to manipulate and others. And then also, one way to generate return that we haven't really looked at and been able to access in the past is things like digital assets or even venture capital for that matter. And we're going to be doing that in a combination of ways. First, it's going to be, as I mentioned, through a limited partnership called Trailhead Growth. That'll be available for qualified purchasers, but also in the near future, we should have a spot Bitcoin ETF that will likely look to apply to a much wider set of our clients in the future once that's available. So we look forward to sharing more about that. So now let's turn to the special topic with the remaining time we've got here, and that is digital asset opportunities, because this is things, even though it's only been 12 months, or 11 and a half, I guess, so far in 2021, a lot has changed and a lot of capital's moved around within digital assets that bears worth mentioning. But I'll focus on a few areas that we think are interesting and have been putting some research effort into here on the next slide. So one thing I wanted to mention relating to digital assets would be that there are both public opportunities and increasingly more public opportunities and private opportunities. On the public side, or on the liquid side, it is interesting. A lot more companies are coming public that cater to digital assets, or that are digital asset companies. Some of them are coming through SPACs. There's a company called Backed out of Alpharetta that's providing Bitcoin rewards to credit card members that are associated with Visa, I think, and MasterCard. But there's also more well-known companies that you may know of, like Coinbase is now a public company. And there's going to be others coming here shortly that I think will be increasing the availability of getting access to those fairly easily. There's also Bitcoin mining companies. Cryptocurrencies are public and available, just unfortunately through Schwab and Fidelity at the moment. The opportunities to access them are fairly limited. So you have to go to places like Coinbase now and others to get your exposure. But those are very liquid. And we still are putting a very large research effort into Bitcoin and increasingly Ethereum, because Ethereum, if Bitcoin is digital gold, that's been the kind of moniker for Bitcoin. Ethereum is actually the application or the smart contract rails that a lot of very interesting technologies are being built on top of. So we have to keep an eye on both of those, I think, to really understand the opportunity set. On the public side, there's also something called yield farming, which is a way to generate yield from digital assets. It's actually not for the casual observer, because it does take a lot of time to move your tokens or currencies around to where the highest yield can be found. But that is an available option for some people that want to put the time in to do so. And yields can be pretty substantial if you do that, somewhere between 18 to 20% if you can spend the time. NFTs are non-fungible tokens. These have gotten very popular in 2021. There's a website called OpenSea, which is really the marketplace for a lot of the digital NFTs that are being traded right now. But something that we think is really more of a phase 2 for us to keep an eye on what's going on there. But this is where a lot of digital art or music or royalties is changing hands right now. And it's something to really keep an eye on, because it's changing very rapidly and capital's moving there very quickly. Stable coins is something to keep an eye on as well, that is available to a lot of to anyone in the public. Stable coins are basically digital assets that are backed by dollars, essentially, or currency. They do have yields attached to them. And this is, I think, something that a lot of institutions are looking at creating their own to really figure out a way to try to give investors with cash more options. But this is something that we find really interesting and we'll probably focus on in 2022 once we get some other areas figured out. And then finally, digital real estate. This is something that I think is very speculative, really have no interest in right now, but there are increasingly large transactions occurring in digital worlds, essentially, that are breaking records. When you'd be surprised if you follow some of the space. Decentraland has had a number of $1 million digital real estate transactions, which I find really incomprehensible. But it's something that we have to keep an eye on. On the private side, this is an area we spent a lot of time, because I am very interested in figuring out ways to benefit, I think, from some of the volatility that's in these digital assets. And one of the ways you can do that is through things like digital asset hedge funds, which are basically trying to create arbitrage opportunities. And arbitrage is really nothing more than trying to exploit the price differences on one exchange for the same asset versus another. So if Bitcoin trades on both Coinbase and Gemini, which are both custodians, but they have different prices, well, you can arbitrage that difference and earn a return that essentially is taking not much market risk. And there's also private digital asset companies, things like private Bitcoin mining opportunities, or digital asset companies that have really unique value propositions that we've spent a lot of time looking at, and we'll be looking forward to bringing you up to speed on some opportunities in the future on that front. But these three areas are the areas that we'll be spending most of our time right now, because the universe is growing rapidly, and we can't spend time on everything. So these are the areas that I think are the largest, but also worth mentioning and focusing on for right now. And then, just looking at briefly for those that weren't able to, attend one of the webinars we had more recently relating to the Trailhead growth opportunity. This is a slide, I think, that just tells you how much runway is left on things like Bitcoin. And just briefly, on the right-hand chart, you can see Bitcoin. This is back in the end of 2020. So this has grown a little bit, but this is total world assets in trillions. And Bitcoin at the time was represented about $1 trillion in assets on a global opportunity set that was in the hundreds of trillions. So representing roughly 0.6% of all global assets. Equities representing something like 65 trillion, government bonds 42 trillion, investment grade bonds 26 trillion, and so on and so forth. So Bitcoin is, I think, to net it out, just a fraction of global assets. And I think every year we should expect that amount to increase as institutional adoption continues to grow larger. Because right now, most of the investors in this space are still more individuals. And then once I think institutional investors start to step in larger quantity, then that's where you could see Bitcoin moving to those very high levels. And then just looking at kind of how to think about cryptocurrency or digital assets in particular is really, the analogy could be, looking at the internet and kind of how that growth adoption occurred over time. And what it attempts to show you here is the number of internet users, which is on the left-hand side, versus the number of blockchain wallets over time. And I think what this just shows you is that we're still in the very early innings as far as number of blockchain wallets that are opened and out there. And that as more and more people come into this ecosystem, that will drive adoption for digital assets of Bitcoin in particular to higher levels. And you're already starting to hear other countries talk about potentially accepting Bitcoin as part of their payment system. El Salvador being the first country to do that officially, but others are following suit because they realize there is an opportunity here to be kind of a first mover in that space. And I did want to point out with this chart that with opportunity comes, with returns like this. Is a year-to-date chart, by the way, of both Ethereum and Bitcoin. You can see Ethereum had an amazing year, up almost 500% for 2021. Bitcoin up about 75. But with great opportunity comes great volatility. And you can see we've had many periods, even over the course of this year, where Bitcoin has been down 50%. So at one point, Bitcoin was up 125%, then it went all the way back to zero from middle of April to late July. You can see here in Ethereum, the price movement was even potentially more visceral, down 75% at one point, it looks like, from 475 down to 150%. So we can actually, it's probably closer to 66%. So we can see here, I think the point I just wanted to make here is that with great return opportunity comes great volatility. And so this is just something to keep an eye on or be mindful of when we're getting into this space. And I know we'd stop for questions, but I think because of what's going on with some of the tech issues, we obviously don't have any questions. So if you do have any questions as a result of this presentation, feel free to send me an email or your advisor an email. And I look forward to speaking to you next month in person. Next month, we'll also have our quarter end review and have some words from our founder, Hank McClarty. So look forward to speaking to you then. Thank you.